what is the matchmaking process for you?
Choosing your investor is even more important than choosing like a marriage partner because sometimes it lasts longer, right?
The financial return is the crucial piece for the sustainability of the corporate venture capital arm.
And so we don't limit ourselves to specific thesis or strategy. And it's really all about the founders.
Hello and welcome to Connected. I'm Divya Gopalan. I'm sure you're familiar with Google, Apple, Samsung, and Microsoft, and you have a pretty good idea of what they do. But what do you know about their venture capital arms? Well, Apple was among the earliest to get into what's called corporate venture capital, or CVCs, back in 1984. And what startup did it invest in? Adobe, creator of the PDF. So knowing where a company invests gives us insight into where and how it looks to grow. And for startup founders, it sheds light on where they can go for funding VCs or corporate VCs to grow their business. And to help us understand how VCs and CVCs find and fund startups, we're joined by Tina Cheng in Taipei. She's a partner at Cherubic Ventures, a global seed-stage venture capital firm focusing on the US and Asia, including Taiwan. And the firm's 200 and some portfolio companies include Calm, Hims and Hers, and 91 App. That's a unicorn from Taiwan. And from the San Francisco Bay Area, we have Kei Onishi. He's the CEO and managing director of Yamaha Motor Ventures. It has $300 million invested in sectors ranging from mobility to health tech and robotics. Thank you both so much for joining us today. I'm going to start with you, Kei. Now, you're in the Bay Area, and many are calling this the golden age of startups. But that's despite what's being called a funding winter. That's where capital funding is somewhat drying up. So can you tell us what startups are making of this and how you're navigating this?
Yeah. So as you know, like currently, maybe some article says that VCs and CVCs are a little bit reluctant to put lots of capital into startups. However, also like a lot of technological advancement is happening, especially around LLM, large language models, that allows startups to drastically reduce the cost to develop products, especially like when you are working on software development, software products. You can, like a ChatGPT can be a really great, junior to mid-level of software engineers that can help you guys to build a great product, drastically reducing the head count as well as the time to the development, time to the market as well. So there are a lot of ways to reduce the cost to build the product and also test the product in the market. So even though it's a challenging situation, there are ways to extend the cash runway and until they see the product market fit and start generating the revenue.
Tina, what's the scene here in Taiwan? How are startups navigating the scene here? And do you think there's more competition to try and get funding here?
Yes, I think after the market crash in 2022, obviously the market has been kind of frozen for fundraising, and we're definitely seeing investors are more cautious and more sensitive to valuation, to due diligence, and they want to see more traction. So I think yes, for startups, they need to be better prepared. They need to show clear path to profitability. And but on the other hand, you mentioned AI. I do see that in areas such as AI, such as sustainability, climate tech, investors are still very willing to invest. So I think it's a little different night and day. Depending on what you're building, you might have a very different fundraising experience.
Right, and if we just kind of focus on the hard numbers here, venture funding doesn't look very encouraging, the growth in venture funding. So how bad is it really, Kei? And what's the response there in Silicon Valley? Which sectors seem to be, we talked about AI, but which sector seems to be hit hardest by the diminishing venture funding?
Yeah. Before I start talking about the specific sectors or technology, let me talk a little bit more about the general sort of like a investment climate and situation. So like compared to the peak of the investment, like 2021, like last quarter, like the first quarter or maybe Q4 in 2023 was down like over 80% in terms of the number of capital deployed to the startups. But actually the Q1, Q2 this year, it hit the bottom. So like we started seeing the uptrend of the entire capital deployed to the startups. So I see the changes, like it's going up. And also when I talk with other investors, they are more, they are showing more excitement in the new startups coming in these days. So absolutely, I'm seeing the slight uptrend at this moment. And however, still certain sectors are in like a difficult situation, especially sectors that requires lots of capital. The often cases it's the something related to the physical products, hardware, material, or some sort of like climate tech companies are working on plant. There's some products that requires plant. Those companies are still in a difficult situation.
Right, so I want to quantify some of this by looking at some of the numbers. Global venture capital has continued to decline over the past 2 years, since peaking at $200 billion near the end of the pandemic. That was in 2021. Now, the total amount of VC funding raised in the fourth quarter last year dropped by 15% from the previous quarter. In the same period, however, significant investment in AI, as we've been talking about, contributed to Europe's unusual 7% growth and helped the US secure half of the global total in venture funding. So, Tina, do you think in that case the so-called global funding winter is temporary?
I think I agree with Kay. We're seeing some more activity now. I think the market has hit bottom. And now because of AI, right, there is bringing new life into a new wave of startup. So I think definitely see more activity in the deal space. But I do think, for certain sectors or certain type of startup, especially the ones who have raised a lot of money during the peak of the markets, they are potentially stuck in a very high valuation. And I think for those companies, they probably need a tough situation where they need, maybe they need more money, but the valuation is too high, and they really need to show growth and traction to fit into that valuation. Otherwise, they're stuck.
Okay, if I want to switch tack a little bit and focus on your CVC. Yamaha Motor Ventures is a hybrid type of corporate venture capital firm. You invest in nearly 10 different sectors, from data to AI to agriculture to digital health. Can you tell us what drives your process in deciding what to invest in, or what's the next thing for you?
Yeah. So we started corporate venture capital activity back in 2015 with two objectives. The first objective is to transform our existing business units, maybe streamline the process or adding new product lineups or transform the business model or something like that. And also another objective is building a new business portfolio beyond the mobility or industrial robots. So agriculture, digital health, those two sectors were chosen as a sort of potential new business units for the future of Yamaha. And also we started the Yamaha Motor Sustainability Fund. We allocated $100 million US dollars specifically for decarbonization. So we want to support the startups that can help Yamaha and also auto industries to decarbonize our supply chain. So the sectors that we chose are coming solely from our parent companies, the strategy.
So let's take a look at things from a startup's perspective. We spoke with Stephen Wang, the founder and CEO of Matterroom. Now, Matterroom is a startup providing software as a service or SaaS solutions for law firms, accounting firms, and other service enterprises. Now, he told us about some of the challenges they face and the type of investors they're looking for.
I think most investors are really only betting against the hard subjects like AI, like automobiles that does self-driving, and semiconductors or biotech is hot. But in the sense of like SaaS, I feel most of the investors only looking to bigger companies. They have certain revenue requirements that as a prerequisite before the conversation. And I also know, especially in Asia, some of the countries have significantly dropping of the investments into SaaS, like 90%. We have been talking to VC and CVC, but what we are really looking for are some VC investors have industry knowledge, because SaaS is all about verticals. We want someone is experienced in professional services or in our domain, so we speak the same language instead of just the guys investing money.
Right, I'm going to ask both of you this question, and I'll start with you, Kay. And it's, if you were to advise a startup on seeking funding, what should they be asking when looking for an investor, Kay?
Yeah, so money is, of course, like currently, of course, like the not so many, not so much capital is deployed to the startups, but actually lots of dry powder is available. So like a VCs or all kinds of investors have cash. They just sort of not deploying the capital. So actually cash is not so expensive, I would say. So the founders needs to make sure that what kind of collaboration or support or resources they want to get out of the investment, that they need to make sure that what they are looking for beyond the cash, that will dictate their funding strategy and fundraising strategy.
So Tina, how do you think a startup or someone looking for funding should decide whether they're going to go for a VC or a corporate VC, a CVC, and what is it that they should be looking for when they're deciding which direction to go?
I think when you're just starting out, you want to make sure you choose an investor who is right for you, right? So I think for VC, we're really neutral, and for corporate venture, sometimes, right, they are serving their parent company. For example, let's say OpenAI, right? They chose to take money from Microsoft. Then it will be hard for them to take money again from, let's say, Google or Facebook or Amazon, right? So choosing corporate venture, there is a risk that you're choosing a side early on. But I will say in general, we do see VC and CVC are in the same round very often, because we're really not competing. For startup, you should think about how different investor can be helpful to you, and try to leverage different investor to give you the resources that you need. So I think oftentimes corporate venture do bring on specific domain expertise, and sometimes you do need that. So I think it's not either or. You can have both. So that's kind of my take.
Okay, as a startup or a small company looking for funding, I think it could be quite daunting trying to go to a big conglomerate, be it Microsoft or Yamaha. So what is the matchmaking process for you? Like, what is it that you look for and they should come prepared with to come to a bigger conglomerate like a CVC?
Yeah, so there are multiple types of CVCs. Some CVCs are only looking at the later stage companies, like a Series C or Series D or pre-IPO. Some of them are very stage agnostic. Some of them are focusing on early stage. Generally speaking, the CVCs, many CVCs are focusing on early stage companies like Series A, B. So actually, they can be very nimble, like they're very quick on the decision making, and also they are very agile to make an introduction to the BUs as a potential partner or potential customers as well. So from the startups viewpoint, maybe it's like echoing myself, but they just need to understand what they need, what they want to get out of the money they are taking from both VCs and CVCs. And I actually completely agree with Tina. So it's like they can mix up lots of VCs and CVCs in the same syndicate. And so as a group of investors, what types of group of investors are very helpful for the startups to go into the next round? That's the question that startups needs to have sort of clear answer.
And what about for you? What is it that you look for? Is there something in particular that you're looking for when they come to you with their idea or proposal?
Yeah. So every time I ask the same questions, which is how Yamaha can help you. So we are not going to invest into the companies that we can never ever support. For example, farmer. There is no way that Yamaha can support such kind of startups. So I want startups to be prepared to that when they are thinking about to talk with CVCs, they need to have clearance about why this CVC.
Right, and I guess that's where it differs, doesn't it, for you, Tina, where there isn't a clear strategy that they need to come with before they come to you, or it doesn't need to be aligned with a certain kind of business or principle. Is that right?
Yeah, I will say we are sector agnostic, so we can invest in any industry as long as there's a tech component. And so we don't limit ourselves to specific thesis or strategy. And it's really all about the founders. So we want to bet on the most brilliant founder who are solving a big problem or who are seeing a big opportunity that maybe no one has seen before. So as an early stage investor, we need to be ahead of the trend. So oftentimes when we invest in something, that trend isn't very obvious yet. So I think that's, for example, when we invest in Calm back in 2014, at the time, mental health is not very prevalent. It's not very popular like it is today. But then we make the investment back then, and several years later, it became a really successful company. So I think for us, it really is about spotting the best founder, no matter what they're building.
Right, and if we go continue trying to discover the intangibles here, when you say spotting the best founder, is there a personality type or a quality in their character that you're looking for?
Yes, obviously they need to be the top, right? They need to have some kind of domain expertise, right? For example, now we're looking at AI, for example. They need to be able to tell us, why they're the best team, they're the most suitable to be building something in this space, in this most competitive industry. What is their secret sauce? What is their team's, previous experience? So there is a lot of intangibles. But then I think it's also some track records that we need to see before we invest into the founders.
Right, and so from the perspective of the startup or the founder, they've said that trust is very important. And again, I believe with a VC, I'd imagine that may be easier because you're dealing with a smaller entity. But with the CVC, how does that work? How do you ensure that trust is there, Kay?
Yeah, so what our fund is actually structure-wise, it's exactly the same as financial VC. We have GPLP structure like Tina's fund, and we always have the same KPIs before we make same criteria before we make the investment decision. So financial comes first, and in terms of trust, there is one point that the CVCs need to care. which is like fortunately VC doesn't need to care. It's about the IP, the intellectual property leakage. So because some corporates had issue around the stealing technology, stealing ideas, and they share the information that shouldn't be shared with BUs are shared, and someone's creates the competitive product. That happened in the past if you look at the long history of CVC. So that's the only piece that's the biggest the item that CVC needs to care about to earn trust.
Tina, I'd imagine there's a certain amount of faith that you put into these founders. So do you have mechanisms to achieve the trust you need and that understanding you need between yourself and the startup or the founder?
Yeah, I think, before we invest, we try to really communicate, right? Really understand, let the founder know that, the communication cadence, for example, and the style that we are comfortable interacting with the founder. So I think, as an early stage investor, I think people often joke that, choosing which company to invest or choosing your investor is even more important than choosing like a marriage partner, because sometimes it lasts longer, right, than a marriage, because from a company that's being funded to an exit event, whether it's acquisition or IPO, it can take 5 to 10 to 15 years. So it's a really long-term relationship. So I think, definitely constant communication, transparency, and trust. I think this is really important and fundamental in a successful, relationship between the portfolio company and their investors.
Kay, you mentioned this about going to a VC does not stop you from going to a CVC. But how do you think that a founder or startup should manage that?
Yeah, so there is always a nuance, but also it depends on the timing of the stage of the startups as well. So the one sort of a superpower that CVC has is potentially CVCs, the parent companies of CVCs can be a customer. So maybe early stage, you don't want to guess that you don't want to be added some corporate color in it. Let's say seed or Series A. You want to be company agnostic. For example, we invest into manufacturing technology companies, and when we are interested in, probably our competitors in the same industry wants to work with them. So if we put too much amount of the capital, too much ownership of the company from the early stage, maybe we, being a shareholder, could be a bottleneck or deal killer for the startups when they are dealing with our competitors as customers. So maybe at early stage, the probably founders wants to get funded from the more the financial VCs heavy. Then at the later stage, after they find the product market fit, maybe that's the time they would start thinking about they engaging with more strategic investors, and they can be a great help to give the access to the market, access to the customers, and eventually it will return to them as a form of revenue.
Right, we're coming up to the end of the program, but Tina, how do you define a successful partnership for both you and a startup or a founder? What makes it successful?
I think, I guess back to what I mentioned earlier, it's really about a regular cadence of, communications, really understand how to work together. For as VC, obviously we want to try to be helpful to the portfolio that we invest in. But at the same time, the portfolio needs to let us know, right, the status of the company. So whether it could be good news and bad news. I think for us, we think if a portfolio founder is really comfortable sharing not just the good news, but bad news with us. And whenever something goes wrong, they come to us for, first. I think that shows, right, trust. That shows that they really trust us to be their partner. So I think, and obviously, for the long term, not just in the beginning, but throughout their journey, we can be helpful along each step of the way until there's exit event. So I think for us, that's how we define success.
Kay, earlier in the program, we talked about Apple and Adobe, but it's not often you get that kind of an impact. So what does success look like to you?
Yeah, so from our perspective, two buckets of success. One is financial return, of course, like Tina mentioned, like a financial return is the crucial piece for the sustainability of the corporate venture capital arm. Often cases, the management says that, hey, we are CVC, we don't need to care about the financial return. As long as you don't lose money, you should be fine. Bring the strategic value to our parent company. When things go well, the parent company's business goes well, that's okay. But when once the parent company's business situation goes sideways, suddenly losing money becomes the first reason to shut down CVC. So like a financial return is absolutely important. But for us, we have another aspect, which is strategic return. So in our firm, we have a KPI, which is like how many the meaningful engagement we facilitated in a year. So how many companies regardless we invest in or not, how many companies we introduce to the parent company, business units, and how many commercial engagements was formed. That's the really important piece of the objective of having CVC. So we are trying to balance the strategic return and also financial return. That's how we measure the success.
We have come to the end of the program. Kei Onishi, Tina Cheng, thank you so much for such an interesting and informative discussion. We'll have to leave it there, but not without a thank you to our viewers too. It's been good to have your company. If you've enjoyed today's episode or have anything you'd like to add to the dialogue, do join the conversation on our social media. And remember, stay informed, stay engaged, and stay connected.